Okay, perfect. Just letting someone in there. So, welcome, guys. I'm really excited to bring this webinar to you. I've known Mark for the better part of probably a decade or more, as a friend, as a business colleague, and I've watched what he's done in real estate, and it is mind blowing. And now he's taking all those skills and applying that now south of the border to some pretty amazing investment opportunities. So I suck at doing intros, but Mark, can we get you on screen? Are you there?
Yeah, here I am. Awesome. Thanks,
There you
Chuck.
go. Yeah, I don't, how do you introduce somebody that's just awesome? You're like, you're awesome. That's cool. Right.
Well,
So,
you're right about knowing each other for a while because it's been back in the chairman's retreat is really where we started, I guess, hanging out. And there was always like there's a few agents that I was really looking forward to seeing every year. And you and Melissa were definitely in that very small group out of what there's like 100 about 100 of us across what well 200 now, I guess, close to 20,000
yeah.
there. So definitely it's good to be here, and I appreciate always appreciate you a lot, Chuck, and always super caring and just amazing what you do as well. So
Thank you, Mark. I have that recorded too, by the way. I just like to
yeah,
say
that's good. He did not pay
that.
me to say that. So
I
I'll
have now video proof of that statement.
yeah, very good. Well, I'm going to go ahead and share my screen for the group here. So let's jump in here, guys. So Chuck, yeah, I'll just super high level background on myself. If you haven't heard of Fair's team, we're north kind of Barrie is our headquarters. Started real estate 2007. We scaled our team up. We'll do about a billion in sales volume a year, um, and uh, and a couple of years ago, what happened was I had been investing in real estate along the way. Single family properties we're buying our office buildings, and we're buying the smaller multifamily apartments, 6, 10, 14 unit properties. And it was great until it wasn't great. And what wasn't great about it was two major problems that I was experiencing as a real estate investor, and our clients was number one, the deal stopped cash flowing, as in the deal stopped making more money from the rents that were coming in to look after all the expenses. So that was a big problem. Deal stopped cash flowing. And the other big problem was rent control in Ontario is very difficult. If you go and buy an apartment and there's been a tenant in there for the last 10 years, maybe rent is $650 a month. Market rent is $1,650 a month. In the past, generally, you could offer cash for keys, $5,000, and it would be fine. Well, I found myself offering 10, 20, sometimes $30,000 with a very stern no, get away from me sort of approach, where really that's hard to execute on a business plan. So those are two major problems we were having. Part of the reason for that is that prices grew so much and interest rates went crazy, more than double, right? And so, as you guys know, so that's where it really led us into this other avenue. I'd gone down to Florida, and so our kids are going to school down here now in Florida. And I started looking at real estate pricing, Florida, South Carolina, some of these southern states, and realized they don't have rent control and the deals cash flow. And it reminded me a lot of 2008, 2009 when we started buying deals. These are emerging markets. I'm going to talk a little bit about that. And then I thought to myself, well, we built this Fair's team sales vertical. What if we built a vertical for real estate investors to be able to get access to these great deals without any sort of the complicated work around it? Double tax returns, trying to find the right property in the right area and to make it super simple for them. So that was the birth of Fair's Capital. So really, real estate overall, why get into real estate? Well, these are some of the reasons that a lot of us have that keep us up at night. We're staring at the ceiling, and great questions. Am I going to continue trading, time for money? Will I have enough money down the road? Did I spend enough time with my family? I'm always working. Seeing my child or my parents suffer, not having the resources to help them. Like these are all real problems or challenges that keep us up. I know some of these in the past have really, that's been on my mind as well. So that's where from what I've seen in real estate investors, I've seen that real estate has been the best solution for a consistency basis and to be able to answer those main worries. And so Chuck and I, even though we're both in real estate, we've just seen like 90% of millionaires become that way through real estate. And if you look at your own net worth, there's a good chance a good portion of your net worth is currently in real estate. It might be your principal residence, but that's still real estate. So why real estate on top of 90% that the statistics tell us that it can be an income generating physical asset, which is an inflation hedge. You can leverage real estate. You could put 20% down and leverage something 5 times greater. There's a limited supply. It can be passive as well. Rental demand is actually becoming more of a renter nation. I'm going to be showing you a stat on that. You can depreciate these buildings, which you can use basically over a period of 27 and a half years. You can depreciate or lower the actual value of that building and use that to write off your other rental income. So you can use it as a tax benefit there for you to actually lower the amount of taxes you pay. And you can protect your downside by making sure you buy cash flowing properties. These are the 3 golden rules: cash flow properties, adequate cash reserves, and fixed long-term mortgages. If you do that, it can be very safe. It's always in demand because people always need a place to live, and you can make a difference if you do a really good job at it. So these are the big 5 why real estate. Cash flow, you're paying down your mortgage, there's tax incentives, natural appreciation. This 5th one is something that we do on a very large scale. And I'm going to be talking a little bit more about how these larger commercial properties, 5 units and above, are actually valued by banks and other investors based on net operating income and how we can force that. So why don't more people invest in real estate? Well, I'll just say right now, probably number 1 is everybody's so busy. It's complicated. They're not sure really where to find good deals, not sure how to build a team to take down some of these larger deals. And it can be overwhelming, and they don't want tenant headaches. The late night phone calls from tenants, pipe bursts, boom, insurance not looking after it because you didn't check up on it while it was vacant. You're having to pay that, right? So real estate, it really has been proven to be the bridge to get to the other side for you. And for us, the vision for us is to be able to help support that vision for you and to give you that easy button and to invest in some of these really strong markets, which I'll talk about. So here's some further stats on real estate. So you can see the gap for home ownership to home renting has really grown here. And so this is where we are becoming more of a renter nation. Now, if you can afford a home, this is something that I always say: buy your house. You really you got to get into home ownership because the average net worth for a homeowner is over $200,000 compared to a renter being $6,000. So if you're already in home ownership, that's mission number 1: buy a home with Chuck, because that's what will get you far ahead. But moving forward, it's when you want to invest in something. Where are you going to invest? If you want to invest in something that's growing demand, and we are becoming more of a renter nation because it's become more expensive now to own. And for us, the vehicle that we chose for buying real estate was apartment buildings. And so I started looking at the 100-unit buildings down here in the South. And I realized, wow, like it can be extremely lucrative where you can have a lot of investors pool together and go and compete with the BlackRocks, compete with the insurance companies, and compete with the family offices, where you can get direct access to these large deals, where a lot of these REITs, what they'll do, real estate investment trusts, they'll go buy these value add properties that we're buying now. They buy it in a holdco or a separate company. They renovate it, force the appreciation up, and then they sell it to their own REIT. And the REIT are the retail investors getting we'll say, the property after the cream was scooped off the top. And I know this because I hired a property manager that used to work at one of these REITs. And so he's telling me about this. So why apartments? Well, it's safer in the sense that there are more units there, and there are more people getting into the renting space. So apartments, if you can get into the higher unit count, it becomes more of a leverage play as well. There's lower vacancy risk. So if one tenant moves out, you're not feeling it. The deal we have wrapped up right now you can be 25% vacant and still break even on this property, which is crazy, right? 25% vacancy. Apartments are rare. They're increasing in demand. There's a huge amount of money going after these. If you can get one that's a value add, they're becoming even more rare. Economies of scale. So you got one roof versus like hundreds of roofs. And it's predictable value add. That's what I'm going to be sharing with you guys on how to double your equity. And it's a bigger opportunity to help more people. This shows a graph of from 2000 to 2022, how steady the net operating income of multifamily has been compared to inflation. So that the CPI index, you can see with the dotted line, multifamily income, net operating income is steady. So, and it sits above that. It actually paces quite well above the inflationary numbers. And so the S&P earnings, you can see like you're waking up some days and you're like, boom, 50% of your portfolio is wiped out. If that happened to me in my investment vehicle, that would not be okay. But it happens every day out there in the market. And the killer that gets me is that you're still paying your MER 2.75%, even when you lost 30% on your money or 50% in some cases. This stat here, this slide is really interesting because you can see in 2005 compared to 2023 that there's been a 38% decline from 2005. So what happened was there were more housing starts happening before 2008 when the market went, we'll just say, especially in the US, it went, we'll just say subprime mortgages. They were giving out mortgages at 110%. And then what happened is developers got wiped out in 2008. And so less starts actually happen. And then 2021, you had supply chain issues, which a lot of developers got wiped out. So we got behind on housing starts. And then 2023, you can see there's less housing starts, but we have more population, right? And so there's a 4 million household shortage out there currently. And so these are USA stats, but American stats, but Canadian stats are the same thing. We have a massive housing shortage. And so supply and demand hasn't changed, just interest rates have gone up. This is really interesting. So when we look for markets, we look for affordable markets. And this here shows that the average income in San Francisco, you can live the same lifestyle in Jacksonville for about half the cost. So you want to be able to buy and invest in Jacksonville, not in San Francisco. So here's another example. In South Carolina, Charleston, where we have our fourth apartment that we acquired, 28 to 30% of the average income is going towards rent. Barrie, where I'm from, north of you, it's 50% of the average income is going towards rent. Toronto, 60%. So you want to be able to buy in these more affordable areas because you have a huge amount of population moving in and employment as well. All right, so I'm going to share you. We have this other kind of presentation where we go through from start to finish, but I'm just going to show you one of the 10 steps, which to me is I'm giving you the best out of all steps here because this to me is like the dessert of why I got into multifamily. I fell in love with it. Okay, I'm going to show you why. Okay, and this is going to answer the question. Okay, Mark, how do you double your equity? We're not just we're not winging it. This is an actual factual basis and a mathematical equation. So here it is. For every $100 that we can increase the net operating income. So net operating income, what it is, you have rents coming in, and then you have your expenses, not including your mortgage. The number, that line item is called net operating income. So you have your overall rent coming in, you have your expenses, insurance, taxes, maintenance, and then you have your net operating income. So your net operating income sits above your mortgage or your debt payments. For every $100 a month, we can increase one unit. The overall value jumps by $24,000. That's the value. And so another way to put it is for every $1 net operating income that you can boost, you increase the value of the building by 20. Okay, this is based on a 5% capitalization rate, it's a little bit higher than that, but it's a nice round number. So it's pretty close to that. 1 to 20. That's Okay, so here's the example. 300 units, you go buy a 300 unit building, you buy for 38 million. You need about, say, about half to put down, including renovations and your down payment. So about 50% you're putting down. Okay. Let's go through this. So when we go into buildings, the number one thing we look at is how can we increase net operating income, right? So the first thing we do is say, okay, this 300 unit building, 200 of these units, we know we can renovate it, and we go and shop all the comparable apartments, and we validate that we can get another $150 per month that the market is saying for a renovated unit, we can get another 150. Well, doing that for 200 units, so that increases each unit by 36,000. But when you do it on 200 units, you've increased the property's value by 7.2 million just for that, for renovating. Okay, let's keep going because there's more ideas to increase this net operating income. Loss to lease, which is basically the rents are not brought up to market value. Okay, so aside from that 150, we know that we've shopped all the comparables, and if we do absolutely nothing, and even if we renovate, we can get another $100 in addition to the 150. So we do that for 250 units because 250 units are under market. It increases the overall value by 6 million. So now that's stacking on, right? Value. Washer and dryer units, 200 of the 300, they have hookups, but the owner's not charging them $50 a month for washer and dryer in the unit. So they're having to go around the corner to go do their wash, right? So we're gonna put in washer and dryers, and we're gonna charge $50 a month. If we do that, the net operating income for 200 units is 12,000 extra per unit, or 2.4 million in overall value. Let's keep going. 50 of the units are on the ground floor, so let's put fences around them. I mean, I have a miniature schnauzer. I love my dog. I'd pay $125 to have a nice backyard where I can open the door and let her go run around. Bella, I would do that, and 50 other tenants would as well. And so with that, 125 per month extra, it increases the building by another 1.5 million. Lockers, we can charge $9 per month per unit, 648,000. Valet trash, they don't have to go down to the trash container, right? So they put their trash there on a daily basis. We go pick it up. We charge $20 a month per unit, 1.4. And now here's the magic. Look at this. 19 million in equity you put down. So renovations, you normalize rents, washer and dryer installation, private backyards, parcel, valet trash. You increase the overall building by $19 million. So that 19 original equity is what you had for your down payment plus your renovations, so all the costs to be able to make this income happen. And now you've doubled your equity by doing this. And this is a mathematical equation. It's not like direct comparison approach like regular homes. So this is where it blew my mind. So this is like amazing for an investment because it is very predictable, which for me is I going and starting this business needed to be very predictable because, I'm not willing to risk my reputation for something because the market shifted. In our valuations, we only project 3 to 4% natural appreciation. The rest is forced appreciation. So I'm going to go over an actual live deal. Now, this is more rare because all of last year, basically, we were looking for properties. We're just about to close one in Tampa, and we have one in Charleston. We launched about a week and a half ago, and we're about halfway through. So your timing, Chuck, for this presentation is perfect to actually have a live deal.
I was impressed by the Tampa numbers, and then this one came along, and I thought, wow, it's even better.
Yeah.
So
yeah, this one I'll just say is this one I'm pushing people a little bit more because they're going to get there's no guarantees like in any investment, but based on all the numbers, we're conservative with our projections. We really like the newer vintage on this as well, the newer build. So we have 272 units. It's in Charleston, South Carolina, just outside of South Carolina, Charleston. Newer 2003 and 2008 builds. And so why do we like South Carolina? Similar to Florida in a lot of ways. Our first three buildings we close, our Florida one we're about to in a couple of weeks. We shifted into South Carolina, Charleston, and here are some of the reasons why. I mean, if you haven't been to Charleston, it's just such a pretty city and it's super affordable and it's under the radar now, but it is going to continue to grow. There's no rent control there. It's now the second most popular destination for movers in the US. This is a U-Haul report. They track how many people actually move one way. Affordability, 28 to 30% of the average income is going towards rent. Better quality of life, low property tax, low taxes. It's a diverse economy there. And companies are moving there in droves because they can hire people and not pay them. Like, you remember that San Francisco to Jacksonville? South Carolina is just north of Jacksonville. And so people can live there and make half as much and have the same lifestyle, right? So a lot of people are moving there. Charleston is amazing in a lot of ways. US average job growth is at 33%, and Charleston's above that at 35. 64% of workers are in white collar positions, so willing to pay a little bit more. The growth is growing faster than the national average, and the unemployment is at 2.1% versus 3.9%. And at the end of the day, there's just a lot of companies there, a lot of IT, but it's very diverse. And you can see in the slide here that if one industry goes down, then we're going to be fine. That's a really good thing to look at, is who are the big employers there and what percentage do they have that you're not over leveraging in one industry. That's a really good point, when you're looking at a market. So here are the highlights. It's 144 units. These are large units. Chuck, these apartments, there's like 9.5 foot ceilings. Like, I was shocked. John thinks, my partner thinks, my business partner, he thinks it's 10 feet. I think it's 9.5. But anyways, the point
I
is,
can reach 8 feet with my hands, so that's why clients always go, "How tall is the ceiling?"
Yeah, it's just so rare, right? In these apartments, they're larger 2 and 3 bedroom apartments, 12 to 1,300 square feet. The baseboards, they look like in the luxury homes, like 4-inch baseboards, and it's 97% occupied right now. Now, since we bought it till to this point, so it was a couple of months ago, the in-place rents are about $1,450 approximately, and now the new rents, without doing anything, are at $1,650. So the net operating income has actually gone up quite a bit since we actually purchased it. So you can see the purchase price. We bought it at $163,000 a unit, which is well below replacement cost. That's really important. And it's newer vintage, 2003, 2008, for $23 million. The overall project costs $5 million, all in budget 28. We're raising 12 million on this. Projected value when we go to sell in a 5-year time frame. We do say we're going to sell in 2 to 5 years. Those are our time frames. But based on that equation, it's 12.76 million in projected value creation based on that same formula that I went over with you earlier, based on the value add approach. Overall,
I watched your webinar that you did, Mark, and I thought it was interesting that you said most of the big gains come from those capital improvements. Because somebody said, why don't we just keep it if it's cash flowing well? And it's like, no, you can redeploy that equity to find another project and get that big lift in value from doing those things you said.
You nailed it. And that's the big question. Yeah, exactly. Should we hold on to it for longer than 5 years? And so our thesis is, if we can do 2 of these deals in 5 years versus 1, majority of the gains are in that forced appreciation. So for us, if we can have another value add deal and we feel we're getting a good price on this, like, we wouldn't sell this in today's market, because we feel that this market, we've either hit the bottom or we're near the bottom. Like, this is right across the board right now. I think everything is on sale. This property, we got at a 27% discount from the peak of the market. Like, how much lower does the price need to go before, so in 2008, prices dropped by 40%. And so this has dropped by 27. So it's just like, and we're in a completely different market. We're not in subprime mortgages. With supply and demand is still very it's very in favor of home prices and property prices going up. So part of why we really like investing down south is that not only do you get paid at the end with very high, good amount of profit, but these deals cash flow from day one. So our average distribution on this, we pay out monthly distributions from the profit of this cash flow that's coming in. So we pay our expenses, we have leftover every month. We distribute that to our investors. And so that's where that 6.5% average distribution on an annual basis is paid out, which is nice. It's spending money that comes in as US dollars. And then when we sell, what happens is we give back all the investor capital first. So they have priority sequence before we take any of the profit, Faris capital. Then we take that 6.5% distribution that they were getting, we top it up to 8%. So only after our investors made 8% on an annual basis do we earned the right to participate in the profit. And then at that point, then it goes to a 70-30 split. So once the investors hit 15%, then we go to a 50-50 after that. So it holds us accountable to really deliver to get that on the back end. Now, this it's not for everyone. This investment, it is for accredited investors. That may change in future offerings, but for now, an accredited investor is anybody that you check one of these 4 boxes. You don't need 2, you don't need 3, just one. So one, you either make 200,000 in income, or household income's 300,000, or 1 million in investable assets. And you can use investment properties for this as well, just not your principal residence, or 5 million in net worth. And we do have 100,000 US minimum as well coming in. First class service, just like with Chuck, how he treats his clients, we feel the same way in regards to customer service. And all of our investors have my direct cell number if they have any questions. And, we're there for them on that end. So here are the top 5 reasons on this particular deal. We got this off market. This was a distressed deal we bought from a couple of doctors. They bought it about 4 years ago. They're just tired of this business, especially over the last year. It's been tough. And so off market, relationship with the broker, this never came on the market. And so we got it at a 27% discount. And he called us on a Friday. We flew it on a Monday. We sent an LOI on a Tuesday, and it was done that afternoon, which is so rare for these deals, especially for this asset class. Newer construction, so 2003 and 2008, strong household income. So look at that rent to income ratio, 28 to 30%. Every single one of these units, we can go in and renovate. So the upside lift is $320 in upside there from where in-place rents to where, like, we're already getting $200 without doing any renovation. We only need to get $100 more after we do the renovation, after we do our rebranding and everything, which is, it's as much as a slam dunk as that we can find. And here's the kicker. Here's the cherry on top. We're assuming a 4.12% first mortgage on this. And there's a blended rate with a second at 4.93%. So under 5% fixed, interest only fixed, which is crazy. So if interest rates double, that's okay, because we're locked in for about 7 years on this.
Yeah. And what a lot of people don't know is commercial lending is more expensive than residential. So you're not comparing. A lot of people go, well, that might be what I'm paying on my house, but it's completely different when you get into, this kind of multifamily, like commercial buildings. It's usually 1, 2, sometimes 3% higher.
Chuck, that's a really good point. 100%. So that's why when you see me like really excited, that what Chuck just said is exactly why. So if you say, okay, what does this actually mean to me as an investor? So for you as an investor. So let's just say you invest the minimum, or average investor comes in at 200,000, but the minimum is 100. In year 1, as we're doing the renovations, you can see it's below the average of 6.5% because we're going in, we're pushing rents, we're renovating. Second year, we jump up to a 5.5% distribution, and that's divided up over 12 months. You can see there. Year 3, it jumps to about 7%. And it jumps up every year. And so you can see you invest 100,000 within 5 years, we're projecting to more than double the investment. Now, here's the beauty. For us, over delivering on this is the mission. So with that, you participate in all the upside as well. So say we go in, we kill it, there's no cap for you as an investor. And that's what I really love, because when the market was going crazy, I looked at these real estate investment trusts, and the prices were going up by 20%, but the stock wasn't. And so with these, you participate as a limited partner. So when you're talking to your friends, you tell them you bought a 144 unit apartment building in Charleston, and you're a limited partner in it. You came on as a limited partner. Okay. So there you go, Chuck. How do we do for time?
Yeah, I think we did pretty well. I've been
Okay.
messaging a few people that couldn't get in for whatever reason, had work commitments and so on. But I think
Yeah.
that's great length of time to go over this kind of stuff. I had a question in the chat, not too many questions actually, and I know you mentioned that you've done so many of these that you try and answer the questions before they even come up in a sense. But one of the questions is, why does the current owner want to sell this? We went over that, the doctors, but the question was, why are apartments rare in the US?
Yeah. So generally what happens is, because like if you generally most in real estate investors, they start with single family, and then they'll level up. And so what's happening now is, with such a shortage, okay, you have more and more people that are renting, so you have more and more demand. And so what's becoming more rare, so you have new development coming where they need to charge a higher price. So the thing that I didn't mention earlier is that B class assets that need renovation, that has way more froth or upside, those are extremely rare. And so to have, apartments, there's more inventory coming on, but there's still a shortage for new apartments, right? And so in particular, B class assets or apartment buildings are even more rare, to be able to invest and participate in the renovation and the upside of the rents. We can charge less than new inventory coming on, which positions us in a very strong position, especially in a recessionary market. Generally, people like they like newer feel. They like stone countertops is what we're doing, and vinyl plank flooring, and paint, and everything's new and fresh, but they don't want to pay new build costs or rental costs to be able to get into that. And that's where we come in to be able to support that. And
Yeah,
there's a
we've
lot
seen
of
that
money.
in,
The other thing too, sorry, Chuck, is that a lot
yeah,
of institutions, they love these assets. They're safe. So there's a ton of money chasing, like big money, chasing these as well. So our last deal in Florida and Tampa, we had 40 offers we were competing against, and we got it. We weren't the highest price, if your mind went there. We had our family office partner came in, so we have a very strong track record. We built rapport with the agent, and we position it to close fairly quick as well, which they liked.
yeah. The even if you look at what's happening in Ontario as far as purpose-built rentals, I mean they've been declining for years. It's been condos that have been selling. So we just saw the government announce this, that they're now basically cutting the HST off of purpose-built rentals to try and encourage those. So we're seeing shortages even up here now.
Yeah, you nailed
Yeah.
it. You
And
nailed it.
part of it is because these institutions are coming in and doing the same thing in Canada as the US, but it's never going to be as good here because of the rules as what you have, Mark.
Yeah.
Another question in the chat, it said, why is a certified investor required? What are the risks?
So the
Accredited
investors.
investor is
Yeah,
what they
yeah,
meant, but
good,
it said
really
certified
good.
investor. Yeah.
Yeah, so this is Ontario. So we're compliant with Ontario Securities Commission. We work under an exempt market dealer called Waverly. And so basically, Waverly is like Royal LePage. They're like the broker. And then we have a dealing rep, Madison, on our team is like the agent representing, to make sure that you're that investors that are coming into this, that it's suitable. They call it like suitability. And so one of the requirements they have for these types of deals is that being accredited, they feel, and this was not us, this is Ontario Securities Commission. There was somebody up there that said, okay, here's a line in the sand. if somebody's making, these certain requirements, then we feel that they're not going to invest their last $100,000 and put it at risk. Not that this is any riskier than putting your money in the stock or anything, but that's the reason for it. And so that's why they have these certain levels there that they've imposed on us that we just need to comply with. The other question you had there is, what are the risks? So it's a really good question. So first off, when it comes down to liability, because that's a question when it comes to risk. Okay, what happens if somebody slips and falls? The property goes under, storm hits, bomb goes, I don't even I shouldn't even say that on here, but something big happens. The reality here is that our investors come on as limited partners, and limited partner doesn't mean there's limited benefits. It means that they have limited risk, limited liability. That's why they say limited partners. And so the only thing that they're at risk for is the amount that they invest. And so we, as a general partnership, we have $600,000 deposit down. We're hard on this property. When I say hard, it's non-refundable. So we're putting that down. We're signing on the loan. That's not our investors. For whatever reason, there's no risk on that on that end. Any sort of lawsuit, they come after the general partner, even though that we structure as a limited partnership. So it's a separate entity. We're not buying these personally. But the limited partners are protected from that. When it comes down to the financial risk, okay, so think of it this way. You buy an investment property, say with Chuck in Milton, okay? We'll call it. You put down 50% as your down payment. You have adequate cash reserves, so 6 months of principal and interest payments that are sitting in a reserve for the property level. Plus, you save 10% contingency after you've had an actual contractor go through and give you a firm quote and be conservative. You have 10% contingency there. Plus, you have a fixed debt of under 5% for 7 years. If you do all those three things, what's the chances of that property not making money, especially if you have over 100 units? That what are the chances of everybody moving out? It's not very high. But where operators, they violated one of those three rules, they didn't buy for cash flow, they didn't have adequate cash reserves, and they definitely didn't lock in their interest rate. There's some operators that are hurting right now because interest rates have doubled, their debt payments have doubled, but their net operating income has not doubled, right? And so for us, we're not only buying at a most opportune time, but we're executing in those three golden rules. So for whatever reason, if everything were to go sideways, the worst is you lose the investment. Just think of that as your equity that you would have in your payment in the property you bought, say with Chuck. This is similar risks as a property like that. What are the chances the property's going to go to half, right? And so that's just kind of put into context there and how we operate these properties and how conservative they are. Just remember that 25% vacancy, and we're still breaking even on these properties.
Yeah, that's great. I think, if you look at the upside of doubling, if you even just got your money back from the original, you look at worst case scenarios, you look at the fact that we're buying really at the bottom of the market. Many of us believe that we're headed for our next wave. I mean, you can see it, right? Interest rates are higher. They're going to come down at some point. So yeah, there's a good runway here. And everyone knows that. All the basic supply demand stuff that, the US and Canada are welcoming people in, right? We have, more people than properties. That's kind of the rhetoric that's out there, but it's absolutely true.
I totally agree with that. And going back to when I started 2007 till now, the times where it didn't feel good, to buy, the times where the news is all negative, the times that it wasn't sexy to buy, right? That was the time that you should have bought everything. Like just go back in history and think about it. There's nothing that's changed in supply and demand. It's actually now exacerbated from the fact that many developers have put their projects on hold. So in like 2 to 3 years, Chuck, where are we going to be? Especially
Mhm.
for like like these, like home. I think we're in for another run, like you had said there. And they have a housing, they got a problem now. And so you like the HST, like you had said, they're trying to do things, but it's going to take a lot more than that to fix it.
Yeah, but you also said something in the presentation. You said you're buying under replacement costs. So even if somebody were to build something today, you're already less than that.
And this is where for us, we love hedging our bets. We love like how can we continue to stack on safety after safety after safety and stack the upside as well. Um, and so that's where, like you had said there, the under replacement. I mean, you just do nothing on this and you let it roll. Down the road as the market comes back, it's going to do extremely well. We do have a full-time team of 7 now. So we have professionals that go, like our asset manager has gone full cycle multiple times in this market with this property management company, with the construction team we're working with. And so, like across the board, there's not going to be any surprises there as well, which is another reason why we're really bullish on this deal.
Yeah. Okay, we got one more question, then we'll wrap up because I know everyone probably has to go. So the question was from Roy is what are the headaches the current owners are fed up with? I don't know how much you can give us as far as insight for their
Yeah.
mindset.
Yeah. So for them, you like just imagine being a doctor, right? And operating 144 units. Like these guys are not like there's like we'll call them like mom and pop shops where they're kind of like doing it as kind of a part-time gig. Like you need full-time management to oversee the property manager. You can't just sit back because it's constant things not going right. And over the last 12 months, it's not like it was from the previous 24 months where you saw this big run up where like it was just you could, lease, rents were going up, there was a short tenants were like trying to get places. The market over the last 12 months, like you have to do a good job. You have to call people back, right? You got to make sure that you're staying on top of maintenance. And at the end of the day, property managers have challenges that they need help overcoming, right? And you got to really watch the books, the numbers, and you got to be on top of, staying, maintenance calls as well. And then occupancy is another one, right? Like you got to be on the ball and you got to watch it. And so you can imagine doing that part-time without a full-time team. I mean, that would wear on you, especially over the last 12 months as well. And keeping all of your investors updated because they had other investors come in. Like it's not like all sunshine and rub. Like you got to, there's a lot. Don't kid me. Like I don't want to kid you here. There's a lot of work that goes into these properties, a lot. We're going to go in and rebrand it, Faris Residences, all the signage, we're going to go in and we're going to maintain the building. It's on the outside, they've done a really good job, but we're going to take it to the next level. But, maximizing rents, you got to be on the ball on a day-to-day basis. And you need multiple full-time people doing that in order to stay ahead of it.
That's great. Okay,
Yeah.
Mark, thank
So
you.
yeah, the only other thing, Chuck, I'd say is I just shared that QR code. If there's any questions there, feel free. I'll just throw it
You want
back
to
up
pull that
there.
back up on the screen there?
Yeah, if
Yeah.
you if you even if you want to have a conversation, you can just go ahead, scan it there, and then just fill out your information, and then I can give you a call. There's a commit form there, so don't worry if you have more questions before committing. Just go ahead and fill it out, and then I'll be able to give you a call there and answer any questions that you have.
Yeah. Even though we're friends, I was like, you're going to take my call. Like, I was just so like, you're right in there and you're not afraid to have those conversations with people. And I think the transparency goes a long way.
Yeah, first time around, there's always a lot of questions, rightfully. I had a lot when I first started, and best to get those answered. And yeah, I'm definitely there for you guys for any questions, especially being that you guys know Chuck. That is means a lot to me. I value our friendship, but I'd say equal to the friendship is the professionalism of what Chuck's been able to accomplish, and the respect he has not only within the community but in the aging community as well. It's been great. So appreciate this, Chuck.